Hello and welcome to our final video in the annuity series. In this video, we are going to briefly discuss mortgage payments. Mortgage is a long-term loan for the purchase of buying a home or other real estate. The property is pledged as security for payment. The down payment is the portion of the sale price of the home that the buyer initially pays to the seller. And the amount of the mortgage is the difference between the sale price and the down payment. A fixed-rate mortgage will have the same monthly payment during the entire time of the loan. Adjustable-rate mortgages have payments that change from time to time depending upon changes in the interest rate. And a point is a one-time charge that equals 1% of the loan amount. An escrow account is an account used by the lender to pay real estate taxes and insurance. The process of making regular payments on the principal and interest until the loan is paid off is called amortizing the loan. A document showing important information about the status of the mortgage is called a loan amortization schedule. So let's look at a brief history of the term mortgage. In the word mortgage, the mort part of the word is from the Latin word mori, or via Old French for mort, which means death. The gage part is from the sense of that word meaning a pledge to forfeit something of value if a debt is not repaid. So literally, a mortgage means a death pledge. The term amortize, as we understand it today, has its root in Old French for amortis, and from Latin mors, originally a legal term for an act of alienating lands, and this meaning to extinguish a debt is attested from 1824. So from about 1824 on, the term amortize was used more for real estate properties and homes rather than its literal meaning for a death pledge. Now, the derivation of the mortgage payment formula comes from the present value formula, and we solve that for R, the periodic payments. So the present value formula has P is equal to R times the quantity 1 minus the quantity 1 plus I raised to the negative n power divided by I. And we solve that for R, so we divide over that fraction part, and then we use the flip multiply rule to have the formula P, the amount of the loan, times I, the interest rate per period, divided by 1 minus the quantity 1 plus I raised to the negative n power. Now let's look at an example. A couple borrows $100,000 at 9% interest as a mortgage loan on a house. They expect to make monthly payments for 30 years to repay the loan. What is the amount of each payment? So we're going to identify each piece. Okay, A sub P is $100,000. Little r is 9%, or 0.09. T is 30, the number of years, and n is 12, the number of times per year we're going to make a payment. Now we're going to substitute this into the payment formula, and we end up with approximately $804.62 as the monthly payment. So this is essentially how a mortgage payment may be calculated. Now, one thing to remember is that this is the mortgage payment against the loan. This does not count the escrow accounts for real estate taxes and insurance. That is added onto this amount and is calculated differently as it is not a part of the mortgage payment. Thank you for your time and attention.